Hey guys, to sit here. It's Friday at 4 p.m. GMT, and this is the this is the time that we go live and we talk about different aspects of and how we go about making profit and cash flow in the business fast. So hi, my name is Sisir. I'm your host for the day, and I'm money coach for female coaches consultants who wants to make more money from business without having to spend more time in business. So today we're going to talk about how do you track investment in a business. It's one of the things that came up quite repeatedly in the last few weeks, and I thought I would just um, share and we can talk about this more in detail. So so now the question is like what we category talking about from investment point of view, like when you spend money in the business, when the cash goes out from the business, then how do you measure that so that you're getting your return in investment? So I would like to share three things that you can do, three crucial things that you can measure in order to in order to measure the right things in your business. The first thing that I would like to talk about is the gross profit. So you might be selling a physical product, or you might be selling a service, and then whatever that is, then you have a cost of fulfillment. You have obligation to do something about it to fulfill your promise to your client. So in order to do that, you will incur cost, and the cost could be, well, if you are selling physical products, so you need to buy physical product to sell. For some of my clients, they sell luxury sofas and paintings and all that. So they buy and sell those things. So whatever they buy is that they want to get return on that. So another case could be that could well be selling your services. So what that means is that then you're selling either your time, or you're using someone else's time and expertise to serve your clients. So at the end of the day, someone is giving that so that they can get return on investment. So number one thing that you need to measure is what's your gross profit margin. That tells you everything pretty much about your business. And whenever I have a conversation with my new client, and I don't even talk about the revenue aspect of the business, because it doesn't really mean anything. The first thing what it really we need to understand is, hey, and what's your gross profit margin looks like. That tells that how well the business is doing, because once we go past the gross profit, then we come to expenses, and then there's nothing much you can do about it. Once you have scrutinized expenses to run your business as effective and as efficient as possible. So the first metric, that how do you track your return on investment, is your gross profit margin. So you want to be looking at the gross profit margin, which is just your which is how much you keep by um, from how much you gain. For example, you sell some program for $100, and then you have to have someone to pay $60, and what you keep is $40 as a margin. So that's what you want to measuring that. The first thing is, what's your margin like on return on investment, because you hired the person to serve your client. That could well be you. In that case, and what you need to do is, you as a business owner of the business, as well as you are the skilled person of the business, you're wearing multiple hats. So both have to be compensated, um, so that it's healthy balance. So you need to be paid as a skilled worker for your business, as well as you need to be paid as a business owner of the business who taken the risk to run the business by having profit in the business. But as skilled worker of the business, you need to be paid for your time and expertise. So the first thing that you need to measure is your gross profit. What does it say about your business? And for example, if you look at in this way, a business doing 100,000 a year revenue, and has a 60,000 cost of sales, cost of fulfillment, and has a gross profit of $40,000, 40%, as opposed to another business with just doing 100,000 in the same revenue, but then it only has 20,000 in cost of sales. So it walks away with 80% gross profit margin. So This business doesn't have to sell more second business compared to the first one, because if the first business does 10x, sorry, 2x, which goes to 200,000, then ends up with not 40,000, then $80,000 gross profit. Let's say still maintaining at 40%. But look at that. The second business is already doing that just by having 100,000 in revenue. The first thing, that the key metrics, how do you what metrics that you measure is just gross profit. That's the number one that you want to be looking at. Then number two, number two is about the payroll, the salaries that happens in the business, because people in the business are the most important asset of a business. You won't be checking, you won't be missing the matrix of how well that is bringing revenue and cash in your business, and that's crucial. You won't be comparing your payroll to revenue as a percentage. That might well be like above or beyond. What I mean by this, like some businesses in some way, what we do is when we measure this, they can be classified as in cost of sales, because without having these people around, without them being involved on a day-to-day helping the clients, your clients, and then there will be no sale. And so you need to classify them as cost of sale, but still they are the operators of the business. So you won't be checking on how well, what's the return on investment on the operator to revenue as a percentage. Or it could well be that they don't some of them, they don't make a direct impact on making sales, but they are part of the business and you need paid for that, and they do behind all the dirty work. But without them, nothing happens in the business as well. It's a bit more like, when you're playing a game, and if you're in football, and like defensive midfielders, they want to call it, like they do the dirty work, try to win the ball from the opponent, but no one really gives them any credit for that. And the really crucial part of the play, because without them, you don't win the ball back. Unless you have the ball, you can't score, right? So that needs to be noticed. So that payroll to, so although these people, the payroll aspect, they thanks, Colin, they are not actually directly generating revenue for the business, and they are a crucial part of how you run the business, how you operate the business. So you want to be careful. You won't be comparing the payroll aspect to sales as well, and what's the percentage look like, and you won't be comparing with the previous quarters and previous years, and that starts to tell you the history about how well your people as asset, is contributing to your sales, in your business. And number three, what I'd like to talk about is the marketing. Okay, let me just grab a glass of water. Okay, number three is marketing. Marketing is a huge aspect of. Let me just stop here for a second. Listen becomes Mohit. Hi, Mohit. So first two metrics are gross profit margin and payroll cost. Yes, that's right. And those are two crucial. If you think about the profit and loss statement, and there are some numbers which are big, in any kind of business, which is what you buy to sell, and then in that one, it might be physical product, we might be hiring operators, then some of that, and then we come into marketing, which is, and you also need to divide marketing into two aspects. And what I found out is most people and put this marketing cost as expense in the P&L, saying, oh, it's an expense in the business. If you already go away with this mentality as saying marketing as an expense cost in the business, then it's very unlikely that you'll do well with the marketing, because you already feel like defeated in the first place. It's just expense in the business. And that's the mentality you're going with anyway. So how about you segregate the marketing into two aspects. And here's what I mean, and here's how you can link with the metrics that I'm going to talk about. Okay, number one, you split the marketing into two parts. One is that you categorize the expenses as your ongoing marketing. You're building your brand, building a company brand, it's a personal brand, whatever that is, building your brand so that people remember you for who you are. And that keeps on, has to be like keep on ongoing. And Coca-Cola doesn't stop from advertising, do they? So, and why should we stop and marketing and what we do? So that to keep going in a business, so you spend on marketing. That's like SEO and kind of things, but that is not directly related, impacted in your sales. That's the first bit. So you just ask this question as a flow chart. This marketing expense, does it directly relate to what I'm doing right now in terms of making sales and business? Yes or no. If it's no, you put in expense. But that is expense. That is you building a brand, and that is something for you. We'll talk about the today's money and tomorrow's money in the next few episodes, and that will be impacted. And then, for now, we just put it in expense. Then we come to the second part, which is your cost of running ads right now, so that you're trying to make sales right now. Those should be classified as cost of sales, should be the part of the gross profit margin. It's more like when we discuss the payroll cost, which is are the payroll costs directly impacting the sales that they're being used to deliver your promise to your clients? If yes, then 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 you classify this under the cost of sales. Then if you're not doing that, and if they are just running the back office environment, then you classify under expenses. In the same way, so when you're running ads to directly make an impact, making sales right now, then you classify under cost of sales. And one of the things that I come across with entrepreneurs, when I look at when you go through the numbers and they all classify this as expense, then what's not giving you is a true reflection on your gross profit, which is the gross driver of your business, and you're not getting that information, and the information is not correct. So you want to measuring the marketing, so you want to be classifying the marketing which is directly related to your sales right now as a percentage of your sales. In this way, so you can measure the metrics that is correct, that's happening right now. So if you run a Facebook ads right now to go to landing page to buy something for some people, to get into your funnel to buy something for you right now, that should be classified as cost of sales, and that becomes part of the gross profit margin. So here's a recap summary for you of the three key metrics that you need to measure. um, are, first one is the gross profit, which is as a summation of which could comprise of cost of running ads and cost of operators in the business, and affiliate and commissions that you need to pay when someone buys from you from their list, and you have to give them commission. But things like that, you have to include that in the cost of sales. And so when you include all of this, so you arrive at the gross profit, which as a percentage of sales. That's the metric number one. Then we go into the detail aspect of like, okay, who's delivering what are we buying to sell here? So if you are buying a product, physical product to sell, then it's easy. Then then you don't have to worry about the payroll aspect of, because it's not related directly to the sales. But if you're selling service, service, and you're a coach consultant, you're selling service, then either you are doing the service and or you're hiring someone else to do that task. Then in that case, then you have to classify, if it's directly related to making a sale, then you have to include that in the cost of sales, and you have to measure the percentage of the payroll cost into as a consulting cost, the payroll cost, and if they had in payroll or not, into the revenue as a percentage. And the third one is marketing. It's the same concept here. And the marketing you classify into two types. One is that you want to expense the marketing cost as ongoing to build your brand an ongoing basis. And the second one is you run as a cost of sales, that would, like cost of running ads, you is directly related to sales. So when you do this, and then you have then you have good handle of what's going on in your business, because numbers do not lie. They tell a story of the commercial decision that you made. This is all the action that you've taken, how the action has turned into results. And that tells a story that, then you can reflect on the numbers and trying to relate back, going back to your commercial decision that you've taken place. You did that 2-3 weeks ago, or 2 months ago, whatever the case may be. So here's what here's the thing that I want to share with you today. And if you get any questions, you're welcome to ask me questions. Okay, so it looks like we don't have any questions. Mohit, thanks, Cecile. This was insightful. Okay, thank you, Mohit. Thanks for tuning in. And yeah, it's great. It's great to have you here and do this every week, and I appreciate that. Okay, guys. So thank you so much for sticking in today, and I look forward to seeing you next week. If you haven't subscribed to the channel, and we'll do that, and I would love to speak to you again on next week, same time, same place, Friday 4 p.m. GMT. Till then, stay blessed, have a good weekend, and stay blessed, and take a good rest. Bye for now.